Artificial intelligence did not begin this decade. It did not begin 5 years ago. It did not even begin with modern large language models. The foundations were laid decades ago. Researchers experimented quietly. Academics debated theory. Engineers built limited prototypes. For years, AI was promising but constrained. It was impressive but narrow. It was powerful but contained. Then something changed. Not slowly. Not incrementally. But at scale. Within a few short years, artificial intelligence moved from a specialized research field to the center of global economics. Corporate earnings calls revolved around it. Stock market valuations reacted instantly to AI exposure. Governments scrambled to regulate it. Universities redesigned curricula around it. Entire industries reoriented themselves around one technological force. That kind of transformation does not happen by accident. Technologies can be impressive. They can be innovative. But becoming economically dominant is something different. Dominance requires structure, infrastructure, capital, incentives, power alignment. AI did not just improve. It became embedded. And embedding is what changes everything. Because once a technology becomes embedded in financial markets, labor systems, and corporate strategy, it stops being optional. It becomes foundational. What makes this moment unusual is not just the speed. It is the depth. AI is now intertwined with cloud computing, with advertising revenue models, with enterprise software, with logistics optimization, with financial modeling, with defense systems, with content production. The scale of integration suggests inevitability. But inevitability is often constructed. The most important question is not what AI can do. It is how it became so economically central, so quickly. Why did capital flow into it at unprecedented levels? Why did infrastructure expand so aggressively? Why did market incentives align so perfectly around it? Because technologies do not scale purely on merit. They scale when systems reward them. And when systems reward something, momentum compounds. What makes AI different from previous technological waves is not just performance improvement. It is capital acceleration, massive financial commitment, data concentration, infrastructure centralization, and market enthusiasm feeding back into corporate strategy. This is not a story about code. It is a story about alignment. Alignment between investors and executives. Between infrastructure and expectation. Between narrative and valuation. Once those align, growth can become exponential. But exponential growth built on financial reinforcement carries risk. When expectations become embedded in stock prices. When capital expenditure depends on continued enthusiasm. When hiring and layoffs are driven by automation forecasts. Then AI is no longer experimental. It is systemic. And systemic technologies reshape economic power. The unsettling truth is this. We talk about AI as if it suddenly became intelligent. But what really happened is that it became economically embedded. And that shift is far more consequential. Because intelligence can be debated. But capital allocation cannot be ignored. The growth of AI is not only a technological story. It is a structural one. One built on compute concentration, energy consumption expansion, cloud dominance, data aggregation, and relentless capital markets validation. We still don't fully understand how AI got so big. Because we keep focusing on what it can do, instead of examining the forces that allowed it to scale. Those forces are not purely technical. They are financial. They are infrastructural. They are strategic. And once those forces align, size becomes self-reinforcing. This episode is not about fear. It is not about hype. It is about mechanics. The mechanics of capital concentration. The mechanics of infrastructure dominance. The mechanics of market reinforcement. Because when a technology becomes this large, this fast, there is always more beneath the surface. And understanding that surface tension is critical. Not because collapse is inevitable, but because scale changes leverage. And leverage changes power. To understand how AI got so big, we have to start where all technological revolutions begin. Not in code. In capital. The capital engine behind AI. Technological revolutions are rarely driven by invention alone. They are driven by investment. AI research has existed for decades. Machine learning techniques were explored in academic labs long before the current wave. Neural networks were studied long before they were commercially viable. The difference between potential and dominance is capital. For most of its history, AI remained constrained by funding. Research grants were limited. Compute resources were expensive. Commercial incentives were unclear. Then venture capital changed the equation. Technology investors began seeking the next transformative platform. After social media and mobile computing matured, capital searched for a new frontier. AI presented a compelling narrative. Automation. Productivity enhancement. Cost reduction. Scalable intelligence. Narratives attract capital. Capital builds infrastructure. Infrastructure accelerates capability. Capability reinforces narrative. That cycle defines growth. In the early stages of the current AI wave, funding rounds expanded rapidly. Startups attracted valuations based on potential rather than revenue. Large technology firms increased research budgets. Cloud providers expanded data center capacity to support AI workloads. This was not incremental growth. It was industrial-scale investment. Compute clusters required massive energy consumption. Specialized chips were manufactured at unprecedented scale. Supply chains reorganized to prioritize high-performance hardware. When capital commits at that level, reversal becomes expensive. And expensive commitments create momentum. Public markets amplified the effect. Once AI-related firms demonstrated revenue growth or even credible integration plans, stock prices reacted. Valuations expanded. Market capitalization increased. Rising valuations made further capital raising easier. This is where scale accelerates. Because public markets do not only reflect reality, they shape it. Executives observe stock reactions. Boards monitor investor expectations. Analysts revise projections based on AI exposure. Firms that signaled AI leadership were rewarded. Firms that lagged were penalized. Capital markets became reinforcement engines. Once reinforcement begins, corporate strategy adapts. Budgets are reallocated. Headcount shifts. Automation projects accelerate. This creates operational expansion. Operational expansion requires more compute. More compute requires more infrastructure. Infrastructure requires more capital. Another loop forms. AI did not scale because it was impressive. It scaled because financial systems rewarded its expansion. And when financial systems reward expansion, size compounds. The concentration of capital also mattered. Large technology firms had access to vast cash reserves. They could deploy billions into AI research without immediate profitability. They could acquire smaller firms. They could absorb risk. Smaller competitors struggled to match this pace. Capital concentration created competitive asymmetry. Asymmetry leads to consolidation. Consolidation leads to control over infrastructure. Infrastructure control increases barrier to entry. Barrier to entry stabilizes dominance. Dominance attracts more capital. Capital deepens dominance. The capital engine behind AI was not accidental. It was systemic. It involved venture funding, corporate reinvestment, public market enthusiasm, cloud infrastructure scaling, hardware manufacturing expansion. Each layer reinforced the others. Once compute clusters were built, they had to be utilized. Utilization required product deployment. Product deployment required user adoption. User adoption required marketing and integration. Integration required enterprise partnerships. Partnerships required credibility. Credibility was enhanced by the infrastructure that made it inevitable. Capital alone does not create dominance. It accelerates potential. Infrastructure determines scale. Artificial intelligence did not become central because algorithms improved. It became central because infrastructure expanded aggressively enough to support deployment at industrial levels. That distinction matters. Because infrastructure is physical. It is expensive. It requires coordination across energy systems, hardware manufacturing, cloud architecture, and global logistics. And once infrastructure reaches a certain size, it creates its own gravity. Let's begin with compute. Modern AI models require enormous computational resources. Training advanced systems involves processing vast datasets across thousands of high-performance chips simultaneously. This is not a desktop environment. It is warehouse-scale computing. Entire data centers optimized for parallel processing. These data centers require massive electricity consumption, advanced cooling systems, specialized networking hardware, secure geographic placement. Scaling this infrastructure is not trivial. It requires billions in upfront investment. Once those investments are made, the economic logic shifts. Underutilized infrastructure represents inefficiency. Efficiency demands deployment. Deployment increases adoption. Adoption justifies further infrastructure expansion. The loop continues. The firms capable of building this infrastructure were already positioned at the center of the digital economy. Cloud providers controlled server networks. They managed global distribution systems. They operated hyperscale data centers. AI did not require building an entirely new ecosystem. It required upgrading an existing one. This gave incumbents advantage. Because infrastructure consolidation reduces friction. And reduced friction accelerates scale. Now consider hardware. High-performance chips became strategic assets. Manufacturing advanced semiconductors is extraordinarily complex. Production requires specialized fabrication facilities. Supply chains span multiple countries. Raw materials are limited. When AI demand surged, chip production became a bottleneck. This bottleneck concentrated power. Companies that secured supply gained leverage. Governments began treating chip manufacturing as national priority. Subsidies expanded. Export restrictions emerged. AI infrastructure became geopolitical. This is where inevitability forms. When governments align industrial policy with technological growth, scale deepens. Because infrastructure becomes national interest. Energy consumption adds another layer. AI training consumes enormous electricity. Energy grids had to adapt. Utility providers forecast increased demand from data centers. New facilities were planned near power sources. Renewable integration discussions intensified. When energy systems begin adjusting to support a technology, that technology has already reached systemic relevance. The scale of AI infrastructure is not only digital. It is industrial. It reshapes electric grids, construction projects, water usage for cooling, regional economic planning. This level of integration creates inertia. Inertia resists reversal. Cloud centralization also matters. AI models are increasingly delivered through cloud platforms. This centralizes access. Users do not need local hardware. They access AI capabilities remotely. This increases adoption speed. It also reinforces platform dominance. Because control over cloud infrastructure means control over AI distribution. Distribution channels shape power. When AI became embedded within widely used enterprise software, integration accelerated. Productivity tools added AI features. Customer relationship management systems incorporated automation. Logistics platforms optimized routes using predictive models. Each integration deepened dependence. Dependence increases switching costs. Switching costs stabilize incumbents. Stability attracts capital. Capital funds further expansion. Infrastructure scale also affects research direction. When compute resources are abundant for certain firms, experimentation accelerates. Rapid iteration improves performance. Improved performance attracts users. Users generate data. Data improves models. Infrastructure enables faster cycles. Faster cycles widen the gap between leaders and laggards. This gap is not just technical. It is structural. Smaller firms cannot match infrastructure scale. Barriers to entry increase. Dominance consolidates. We often discuss AI breakthroughs as singular events. But breakthroughs only matter when infrastructure can support deployment. An advanced model trained without distribution remains limited. Distribution converts potential into influence. Influence converts influence into revenue. Revenue sustains infrastructure. This entire system relies on scale. Scale requires capital. Capital built infrastructure. Infrastructure enabled deployment. Deployment reinforced capital flows. This is why AI growth feels exponential. Because infrastructure allowed it to bypass traditional bottlenecks. The digital economy was already mature. AI rode on top of it. There was no need to build user bases from zero. Existing platforms provided distribution channels. Existing cloud systems provided compute. Existing corporate networks provided integration pathways. AI did not emerge in isolation. It attached itself to established digital architecture. This attachment reduced friction. Reduced friction accelerates adoption. Adoption strengthens narrative. Narrative influences capital allocation. Allocation expands infrastructure. Infrastructure deepens attachment. The cycle reinforces itself. Now consider time compression. In previous technological revolutions, infrastructure took decades to build. Railroads required land acquisition and construction. Electric grids required national expansion. Telecommunications required physical networks. AI infrastructure expanded inside existing networks. Cloud computing was already global. Fiber optic cables were already laid. Data storage systems already existed. AI layered on top of pre-built digital infrastructure. This shortened scaling timelines dramatically. Instead of building from scratch, firms upgraded and expanded. This allowed AI to move from experimental to systemic in just a few years. We still don't fully grasp this speed because we compare it to older industrial revolutions. But digital revolutions operate differently. They scale through software distributed across existing hardware. And when hardware expansion is driven by capital incentives, scaling accelerates further. Infrastructure concentration also centralizes risk. When compute capacity is controlled by a small number of providers, dependency increases. If those providers change pricing structures, access shifts. If regulatory environments shift, deployment changes. Systemic integration means systemic exposure. The more industries rely on AI-powered cloud infrastructure, the more sensitive they become to its stability. AI's growth is not simply technological improvement. It is infrastructure consolidation. Consolidation creates efficiency. It also creates leverage. We talk about AI as if it is decentralized intelligence spreading organically. In reality, its scaling mechanisms are highly centralized. Data centers cluster geographically. Compute power concentrates in specific firms. Chip manufacturing depends on limited fabrication facilities. Cloud platforms control distribution. Centralization accelerates dominance. Dominance attracts more users. More users reinforce dominance. Infrastructure is the silent force behind this cycle. Without it, AI would remain powerful but limited. With it, AI becomes unavoidable. That is why the question is not how smart AI became. It is how infrastructure allowed it to become unavoidable. Because once a technology becomes unavoidable, economic incentives shift. Companies integrate it to remain competitive. Employees adapt to remain relevant. Governments regulate to maintain control. Financial markets reprice assets based on exposure. AI did not just grow because it improved. It grew because infrastructure allowed it to scale faster than systems could fully assess. And infrastructure scale is rarely reversed. It is expanded, maintained, optimized. Which means AI is no longer simply a technological tool. It is part of economic architecture. And architecture defines power. The incentive system that locked it in. Capital built the engine. Infrastructure made scale possible. But neither explains why adoption accelerated across nearly every sector at once. For that, we have to examine incentives. Technologies do not dominate because they exist. They dominate because powerful actors are rewarded for deploying them. Once incentives align across investors, executives, employees, and policymakers, growth becomes self-reinforcing. AI's rapid expansion was not just about technical performance. It was about incentive alignment at scale. Start with public markets. When companies mentioned artificial intelligence in earnings calls, stock prices reacted. Sometimes immediately. Sometimes dramatically. Investors interpreted AI integration as future growth. Higher margins. Lower labor costs. Greater scalability. Whether those gains were immediate or hypothetical mattered less than the signal. The signal was modernization. Modernization implied competitiveness. Competitiveness implied survival. Survival implied long-term valuation stability. Markets price expectations. Once AI became the dominant growth narrative, companies were incentivized to align with that narrative. Executives observed the reaction. Boards observed the reaction. Compensation structures are often tied to share price performance. When AI announcements improved valuation, alignment intensified. This is how narrative converts into capital allocation. Capital allocation converts into operational restructuring. Operational restructuring converts into structural change. Now examine corporate behavior. AI promised efficiency. Efficiency reduces costs. Reducing costs improves margins. These efficiencies increase operating leverage. Operating leverage amplifies earnings during growth periods. Markets reward leverage. Rewarded firms expand AI integration further. This is economic lock-in. Once a company restructures around AI-driven efficiency, reversing that structure becomes costly. Processes change. Workflows shift. Hiring patterns adjust. Data collection intensifies. This is not superficial adoption. It is structural embedding. Embedding alters competitive landscapes. Companies that do not automate risk higher cost structures. Higher costs reduce pricing flexibility. Reduced flexibility weakens market share. This dynamic pressures entire industries to integrate AI, even if initial results are modest. Because the risk of not integrating becomes greater than the uncertainty of integrating. Now add regulatory pressure. Governments became aware of AI's strategic implications. National competitiveness concerns emerged. Policy discussions accelerated. Subsidies and research grants expanded. When governments invest in a technology, they reinforce its legitimacy. Legitimacy encourages corporate adoption. Corporate adoption increases visibility. Visibility strengthens geopolitical positioning. Geopolitical positioning increases state involvement. This cycle adds another layer of reinforcement. AI became framed not only as corporate advantage but national infrastructure. That framing increases funding resilience. Because strategic technologies receive protection. Once protection begins, stability increases. Stable funding attracts private investment. Private investment deepens integration. Integration increases systemic importance. AI is now part of national security discussions. Defense contracts. Cybersecurity systems. Intelligence analysis tools. Once defense sectors integrate AI, scale deepens. Because defense budgets are large and relatively stable. Stable funding supports continued research. Research supports performance improvement. Performance improvement justifies broader adoption. The incentive web becomes dense. Markets reward AI. Executives implement AI. Employees pursue AI skills. Governments support AI. Consumers expect AI features. Expectation becomes default. When expectation becomes default, scale stabilizes. But incentive systems can overshoot. Markets sometimes price in perfection. When expectations exceed deliverable value, volatility increases. Companies may overinvest. Capital may concentrate excessively. Valuations may detach from revenue fundamentals. This does not necessarily reverse growth, but it increases fragility. The larger the embedded expectation, the more sensitive the system becomes to disappointment. This is where we return to the core question. We still don't fully understand how AI got so big because we underestimate incentives. We assume growth reflects capability alone. But growth reflects reward structures. When the reward structure favors expansion, expansion accelerates. When expansion accelerates across sectors simultaneously, scale becomes systemic. Systemic technologies reshape labor markets. They influence education pathways. They alter capital expenditure budgets. They reallocate corporate priorities. AI is now part of strategic planning in nearly every major corporation. That is not accidental. It is incentive alignment. Once alignment locks in, momentum becomes self-sustaining. But self-sustaining momentum introduces risk. Because when too many actors depend on one trajectory, flexibility declines. If AI performance plateaus, expectations must adjust. If regulation constrains deployment, valuation must adapt. If energy costs rise, infrastructure economics shift. Embedded systems are powerful. They are also sensitive. AI is no longer a tool companies experiment with cautiously. It is integrated into growth forecasts. It influences stock multiples. It affects executive compensation. It shapes hiring decisions. That level of integration explains scale. But it also explains why AI cannot simply shrink quietly. Too many incentives depend on its continued expansion. We often imagine technological revolutions as waves driven by innovation. In reality, they are waves driven by incentive structures. AI became dominant because the incentive system rewarded dominance. And when reward structures reinforce growth from every direction, size compounds. The unanswered question is not whether AI will continue growing. It is what happens if the incentive alignment weakens. Because when incentives shift, narratives shift. And when narratives shift, capital reallocates. Capital reallocation reshapes infrastructure. Infrastructure reshapes deployment. The entire system responds. Understanding AI's size requires understanding the incentive system that locked it in. And once locked in, reversal becomes difficult. When scale becomes power. Artificial intelligence did not just grow. It crossed a threshold. There is a difference between a powerful technology and a systemic one. A powerful technology improves productivity. A systemic technology reshapes power. AI is no longer simply improving tools. It is influencing capital allocation, labor structure, market valuation, geopolitical positioning, and institutional strategy. When scale reaches this depth, growth is no longer the primary story. Concentration is. Power in modern economies often follows infrastructure. Railroads concentrated transport power. Electric grids concentrated energy power. Telecommunications concentrated information power. AI infrastructure now concentrates cognitive leverage. And cognitive leverage affects nearly every sector. The firms controlling large-scale AI infrastructure now influence cloud pricing structures, data governance standards, enterprise software ecosystems, access to compute capacity, deployment pipelines for automation tools. Artificial intelligence did not scale because it was impressive. It scaled because capital aligned with it. Because infrastructure expanded behind it. Because incentives locked it in. Because markets rewarded it. Because governments prioritized it. Once those forces converged, growth became self-reinforcing. And once growth became self-reinforcing, scale accelerated. But scale is not neutral. Scale redistributes power. It shifts bargaining dynamics. It alters cost structures. It concentrates infrastructure. It embeds expectations into financial markets. AI is no longer an emerging tool. It is part of economic architecture. And architecture shapes behavior. Companies plan around it. Workers train for it. Governments regulate it. Investors price it in. The reason we still don't fully understand how AI got so big is because we are measuring it the wrong way. We measure performance benchmarks. We measure product launches. We measure valuation increases. But the real shift happened underneath. In capital markets. In cloud infrastructure. In incentive systems. In geopolitical strategy. Once those aligned, AI did not just grow. It locked in. And locked-in systems are difficult to reverse. The next question is not about innovation. It is about consequence. If AI is now systemic infrastructure, what happens to labor markets? If automation becomes financially rewarded at scale, how do employment structures adjust? If cost efficiencies become central to competitive advantage, where does human value shift? In the next episode, we move from capital and infrastructure to impact. If AI takes over key sectors, we lose something. The question is not whether jobs disappear overnight. It is how incentives reshape work itself. If you want to understand how technology, capital, labor, and power intersect beneath the headlines, subscribe. Not for hype. Not for panic. For structural clarity. That influence is subtle. It does not look like monopoly in traditional industrial terms. It looks like dependency. When businesses rely on AI-powered cloud platforms for daily operations, switching costs increase. When those platforms control training capacity, research access narrows. When research access narrows, innovation concentrates. Concentration amplifies power. Power reshapes competition. Competition reshapes market structure. AI is becoming an invisible backbone. It sits behind financial modeling tools. Behind supply chain optimization systems. Behind cybersecurity defense platforms. Behind logistics routing software. Behind customer interaction systems. When backbone technologies consolidate, their operators gain leverage. Leverage does not always manifest in visible control. It manifests in subtle influence over pricing, access, integration pathways, and ecosystem standards. Now consider labor markets. Automation changes bargaining power. If AI systems can perform tasks previously requiring specialized knowledge, labor supply dynamics shift. This does not eliminate jobs instantly. It alters wage pressure. It shifts skill demand. It changes training priorities. Workers adapt. Educational institutions adjust. But adaptation takes time. During that time, firms gain relative efficiency advantages. Efficiency advantages increase margins. Higher margins attract capital. Capital deepens infrastructure. Infrastructure strengthens automation capacity. The feedback loop tightens. AI size also affects political decision-making. When a technology becomes central to economic competitiveness, policymakers treat it as strategic infrastructure. National strategies emerge. Funding increases. Regulation evolves. Geopolitical tensions can revolve around access to hardware and talent. This elevates AI beyond corporate growth. It becomes national leverage. National leverage alters diplomatic positioning. Export controls shape supply chains. Subsidies reshape domestic production. International coordination becomes more complex. The scale of AI thus extends into statecraft. This is when growth transforms into power. And power invites scrutiny. The larger and more central AI becomes, the more stakeholders it affects. Investors monitor valuation exposure. Workers monitor employment implications. Governments monitor strategic vulnerability. Consumers monitor privacy concerns. Systemic technologies do not operate quietly. They generate reaction. But reaction does not necessarily slow growth. It often reshapes it. Regulation can formalize dominance by raising compliance costs for smaller competitors. Compliance costs increase barriers to entry. Barriers to entry consolidate power. Consolidation stabilizes incumbents. This is not unique to AI. It is common in technologies that cross systemic thresholds. Now consider capital markets again. AI-driven firms command significant market capitalization. Indices reflect that concentration. Retirement funds hold exposure indirectly. Institutional portfolios depend on performance of AI-integrated firms. When financial markets embed exposure broadly, volatility in that sector affects entire portfolios. Diversification becomes more correlated. Correlation increases systemic sensitivity. If AI valuations rise, wealth effects strengthen. If they decline sharply, market indices feel pressure. This financial embedding deepens power. Because AI is no longer a sector. It is integrated into index weightings. When a sector becomes embedded in passive investment flows, capital allocation becomes partially automatic. Automatic allocation sustains size. Size reinforces influence. Influence stabilizes expectations. Expectations sustain valuation. But scale also introduces fragility. The more central AI becomes, the more the system depends on its stability. If infrastructure experiences disruption, ripple effects spread. If regulatory constraints slow deployment, corporate forecasts adjust. If technological progress slows relative to expectation, valuations compress. Systemic size amplifies impact in both directions. This is the paradox. Scale creates dominance. Scale also increases sensitivity. AI's growth is often described as inevitable. But inevitability is a function of alignment. If capital, infrastructure, incentives, and political support align, scale compounds. If alignment weakens, trajectory changes. Right now, alignment remains strong. Capital continues flowing. Infrastructure continues expanding. Enterprises continue integrating. Governments continue strategizing. But alignment is dynamic. Economic cycles shift. Energy costs fluctuate. Regulatory frameworks evolve. Public sentiment changes. Systemic technologies must navigate all of these pressures simultaneously. The larger they become, the harder navigation becomes. Because stakeholders multiply. AI's rise is not simply about innovation. It is about leverage. Leverage over cost structures. Leverage over data flows. Leverage over decision-making processes. Leverage over capital allocation. And leverage, once accumulated, reshapes power hierarchies. We still don't fully understand how AI got so big because we focus on intelligence metrics. Benchmark scores. Performance improvements. New model releases. But those are surface indicators. The deeper transformation occurred when AI crossed from tool to infrastructure. When capital locked in. When incentives aligned. When markets rewarded integration. When governments prioritized scale. That crossing changed everything. Now the question is not how large AI will become. It is how its size will reshape economic power. Because when infrastructure, incentives, and capital converge at scale, growth becomes influence. And influence becomes structural. Structural technologies define eras. Electricity defined industrial expansion. The internet defined digital globalization. AI may define computational centralization. But unlike previous eras, this transformation is unfolding inside an already interconnected global financial system. Which means scale propagates faster. And systemic implications appear sooner. AI did not become dominant because it was simply advanced. It became dominant because it was embedded. And embedded technologies change power quietly, gradually, structurally. That is the real scale. And that is why we still don't fully grasp how large it has become.